Hi, welcome to this special webcast, which is a pre-property renovation and development session to help you understand the financial and the economic context of what's happening in our property markets at the moment. And you've probably heard me say before that residential real estate is a game of finance with some properties thrown in the middle. And boy, is the world of finance changing in front of our eyes. And it's probably the biggest challenge for people involved in property investment, but particularly people interested in renovations and development. So I've asked my good friend and finance strategist, Andrew Mirams, to join me today, and I'm going to ask him some of the questions that you're probably thinking about what's going on in the world of finance. So welcome, Andrew.
Thank you, Michael. Good to see you.
Now, Andrew, the world is changing, as I was explaining, so maybe you can give us a bit of a background, give us a bit of a history of what's happened over the last couple of years.
Yeah, it's been a very interesting few years. So in late 2014, APRA, so Australian Prudential Regulation Authority, and ASIC and the Council of Financial Regulators, which includes the Reserve Bank and Co., started to write to lenders to see and look at their lending calculators and the standards for which they looked at and did servicing calculators. And so we always used to have some lenders that were more friendly than others. So that was late 2014. We saw the first raft of changes come through in May, June of 2015. That was when the servicing restrictions really started to take force. What's happened since then? The regulators have talked about having a 10% year-on-year growth for investor lending, trying to just slow down the lending markets. Mostly, as you know, Michael, the Melbourne and Sydney markets have been quite buoyant in that time. So really it was a blunt tool to try and slow down two primary markets, which were those two. Then they started to look at other debts. Then we've recently had an interest-only cap where by some lending standards around the world, normal inflows of lending is about 30% of your normal inflows for lenders. We had some lenders in the 40, across the board was about 41% of all new borrowing was interest-only. So there were some worries and concerns that could people manage that. And the most recent change now, and the thing that's really taking bite, is living expenses and doing correct analysis on what people actually spend versus what they earn, and can they afford their current debt load whilst also meeting their living expenses. So it's been quite an interesting ride we've been on, Michael.
As a property investor, I don't enjoy this, and I'm sure a lot of your clients and mine don't either. But if we look at it at a big picture level, what it's doing is creating a level of responsible lending and giving security to our banking system, because our banking system is really very much underpinned by residential real estate. And I guess the regulators didn't want us to get into the position that some overseas countries did, Andrew.
Absolutely, and really that's sound. You and I, Michael, have been through some cycles, even though we're both young guys. But we've seen cycles. You don't want boom bust. It's not healthy for anyone, and it's not good. So the regulators, a lot of their measures have been really well thought through. I think there's been a couple that could have had some consultation, and I still think there is a level of uncertainty with living expenses. It's not a matter of, you earn more so you have to spend more. It's more you can, not you have to. So I still think there's some work to go with the living expenses and the other debts and debt servicing, but it's an interesting time.
So what you're actually talking about there, Andrew, to make things clear, is the serviceability model that the banks are using, taking into account how much you earn, how much you spend, and even if you live at home with mum and dad and don't pay any rent, they still have calculations. So Andrew, on that line, I'm finding people who can actually afford to pay, but the banks are saying, no, you can't. So maybe you could explain a little bit about the difference between serviceability and how the banks see it, and maybe a more layman term that I'm using of affordability.
Yeah, look, it's a great question, Michael. The affordability, we've got lowest interest rates ever. You're talking 3 and 4, and now sort of some rates getting even into 5%. And we've got people up in arms at 5%. If I'd offered you 5% 3, 4, 5 years ago, you would have snapped up that chance.
Andrew, we both remember that for many, many years, any home loan under 10%, you were happy, weren't you?
Absolutely, yeah. So that's just how our world's changed and how we've grown, and people are taking on more debt. So in relation to serviceability and affordability, if you've got an interest only mortgage at say let's say 5%, and you're getting rent at a yield of 4% coming in, there's actually not much differential. You've got a little bit of property management, you've got some costs you've got to pay, so it's actually quite affordable. The difference with serviceability is then the banks put on a buffer, and they're sort of at an average rate of about 7.5%. They then, if you've got an interest-only loan, they then take your mortgage over that shorter term, and they apply some living standards, and it's now based. They use some basis around what you earn and how much versus what you earn, then you're probably likely to spend. They put that all in, and out comes a metric which then says this is what your servicing looks like.
So what they're doing is stress testing to make sure that you can cope if interest rates go up. Not that they're suggesting interest rates are going to go up to 7.5%, 8%, but they want to make sure you can and pay a principal and interest loan, even if your loan isn't that. And so I guess that brings me to my next question, because you mentioned already about interest-only loans and the banks lowering the number of interest-only loans they can lend based on APRA's regulation. So are interest-only loans still available?
Yeah, look, again, absolutely they are. There's some measures being put in place where now if you're lending over 80%, you're being asked to pay principal and interest rather than interest only, and that I don't think that's an unsound practice. You know, if the less you put in, then you should have to. If you can't contribute up front, then I think you should have to contribute a little bit sooner along the journey. Especially if you're getting started, it's not a bad practice to actually get some equity into your portfolio. You can hope that we're going to get growth, but we don't know, as you and I, Michael, know that the markets, we can't control what happens in the market. So having a commitment there is not a bad thing. But interest-only loans are still available. You now pay a little bit more of a premium. So some clients who are having discussions around, okay, you can get a low 4 for a principal and interest loan, or you can get a low 5 for an interest-only loan. And that rate differential now is quite substantial. You're talking anywhere between 0.5% to 1% differential. Some clients then say, you know what, actually I think I might pay principal and interest and get that lower rate. And the difference between your cash flow, you're talking on an average loan size of around 500,000, you're talking about $300 or $400 a month. So it's not a big impost, and it's actually not a bad discipline. So there, like I said, there are some good metrics that have been enforced upon clients, and it's just changing behaviours.
Well, I think you're right, Andrew, that we've gone through the very strong growth period, and we're now at a more mature stage of the cycle where double-digit capital growth or even single-digit capital growth isn't assured. So borrowing discipline is pretty important. Andrew, I think a lot of people think if they take an interest-only loan, it's that forever, but it's not the case. So often if they've got a 30-year loan, the first maybe 3 or 5 years is interest-only. What happens when investors who 2-3 years ago took an interest-only loan come out of that period now?
Yeah, look, again, so you have a choice. So at the moment, you're going to pay a premium. You're going to pay a higher rate. Most of the lenders are still comfortable with, if you meet the requirements, that they will renew your interest-only period. Periods you used to be able to get an interest-only loan out to 10 years. They're now pretty much been pulled back to a maximum term of 5 years and then a reassessment. But if you meet all the criteria and you still tick all the boxes, the interest-only loan is still available. You might have to do a reassessment, and some lenders have different criteria. And my gut feel is that will be tightened up with all the work that's going on. I think there might be some work there that you need to do a full reassessment should you wish to renew your interest-only period. But at the moment, you still can. The great thing with our country, Michael, is there's lots and lots of lenders out there. If one lender won't do it and you meet the criteria at another lender, you can always refinance and take another period of interest only. So it's really, you've got to match up the client's expectations and desires as well as where they fit in the cycle. But yes, you can renew, and there's still interest only available out there for the right investors.
Now, to make things clear, the bank doesn't close down the loan at the end of the period, what they do is they swap you over to principal and interest. But I think what
That's
many
right.
people miss is that if they took a 25-year loan to start with and they're 5 years into it, the principal and interest payment is now made over the last 20 years, the balance of the term of the loan. So sometimes they've got to end up paying just a little bit more than they expected, Andrew.
Yeah, that's right. And look, and building a property portfolio and a wealth portfolio is all about the accumulation. So actually having some debt structuring, some debt repayment isn't the worst thing in the world. While you're accumulating, you can build in equity. As a rule, and with a lot of the work the regulators are doing, we generally lack financial discipline. So if it's the right thing to be paying principal and interest, it's not the worst thing in the world.
Makes sense.
And interestingly, it actually helps your serviceability now, Michael, because you're paying over a 30-year term versus that 25 or 20. So the assessment has gone full circle, whereas now it's actually better for you.
That's interesting. That's great. What's happened to loan-to-value ratios? In the old days, you could borrow 90, 95%. Now, of course, with equity release against your other property or your home, you could borrow 105, 110%. What are the rules today?
Yeah, look, the same rules apply. They're just a little bit tighter in the way we have to regulate and what we have to meet. So you can still get an equity release. You can still take money out if you've got equity in your home or another investment property. You can still use that to buy more property should you meet all the requirements. But loan to value ratios where we're able to get for investors and when you think about it, Michael, a 95 interest only investment loan, 95%. So, the house was worth 500 and your loan's 475. There's actually not a lot of margin in there. If you think about that, it does make sense for those people to be having to pay principal and interest. As an investor, 95 is basically gone. You can still get it if you're buying a home and you're paying principal and interest, but really now you're talking about a 90%. There's a lot of postcodes that now have some restrictions. You and I both know in Melbourne and Sydney, we travel a bit. There's still a lot of developments going on and there's some concentration risk in some certain areas. There's also some less desirable postcodes, in some mining towns and things like that, where you're going to have to contribute more just because of the boom-bust cycle that they've been through. But as a rule, you can still get up to 90% as an interest-only investment loan. The interest only is probably becoming more scarce and probably now having to pay principal and interest, but you can still get an investment loan. Otherwise, 80%, the old rule of the 80-20 is still there, and people are still able to get, if you put in 20%, you're still able to pretty much get what you were able to get in times past.
Now, there may be some people who are listening to our conversation and thinking, I'm self-employed. How do I overcome the hurdles? Is it harder for self-employed people today?
Oh, we love self-employed people here, as you know, Michael.
You are, I am. I know what it's like.
Yeah. So I think having a specialist that knows how to work with self-employed clients, there's a whole range of different rules that the banks look at. Some take over 2 years of your financial data. Some take 1 year. Some use different forms to assess your income. It's really interesting, but self-employed clients generally are aspirational and a bit entrepreneurial, so they will find ways, if they're earning the money, to meet the bank servicing criteria. Loans are still there. We have a very high proportion of our clients are self-employed. We like working with them because of that reason. Like I said, they're entrepreneurial and aspirational. So yeah, absolutely. Self-employed clients are very much still open for business.
But I guess we've got to accept the fact that banks are money shops and they're open for business as well. They're wanting to lend. They're not going to make money. They're not going to get their shareholders dividends unless they make money. But they're being a little bit more cautious. And again, as we said at the beginning, that's not a bad thing because we don't want our banking system to fail. And what this is doing is slowing down the markets in a generally low interest rate environment, and that's much better than slowing down the markets by having a high interest rate environment. Andrew, we have over the years dealt with a lot of expats. They seem to be having a harder problem as well. So I'm not talking about foreign residents, but Australians who are working overseas. What's up with them?
Yeah, look, it's interesting. With anyone earning a foreign income now, they've been thrown into the one big bucket. So what we had was some non-residents and some people earning money offshore, whether they're Australian residents or not. And the forms of which we have here in Australia and the way we assess income versus in some Asian countries, even some European and things like that, they don't have pay slips, they don't have tax returns, they don't ask for the same amount of. So the banks and the regulators were saying, look, we might have some issues here with the forms with which we're actually proving their income standards. So what has happened is now a significant more scrutiny on our expats. They have to provide us letters and 6 months of statements to prove the income. They then we have to discount their income for exchange rate movement risk. We have to then apply a further premium to or discount to their income. And then we have to apply Australian tax rates. So they might be earning income in an Asian country at 0% tax or at 15% tax, but we have to then apply the Australian tax rates. And then the final whammy seems to be, because they're not paying tax here, Michael, they're non-resident for tax, we can't use any negative gearing. So the servicing tests for our expats are quite restrictive to them being able to, and it's interesting because we have lots of conversations with expats all around the world, and they can't understand it. So I've never made more money, but you're telling me, Andrew, I can't borrow. So it's a little bit restrictive in line with a lot of the other restrictions that are going there.
Andrew, another subset of lending is for self-managed super funds, and a lot of Australians are taking their financial futures in their own hands and setting up their own self-managed super funds to buy property and invest in their self-managed super fund. Now, let's be clear, we're not giving any advice that that's the right thing to do, because we're not allowed to. That's a requirement of a financial planner. But the concept is people are doing that. What are the bank's policies currently with regard to self-managed super funds?
Yeah, again, that was viewed that self-managed super funds was distorting the markets and all these wealthy people running out and buying property. It's actually a bit of a furphy. That represents 0.001% of the market if you actually break it down to what self-managed super funds hold in residential property. But just the same, they've been now asked to restrict your LVRs. So now an LVR for a self-managed super fund is maximum 70%. The servicing is quite strict because of the SIS Act and the Self-Managed Super Act. So they're quite restrictive in terms of their servicing. And on with a 70% loan to value ratio, you then need to have 10% as a buffer effectively in there as well. So you're sort of now starting to talk about a 60% LVR when you've got to put in 30% plus all your stamp duties and costs, plus have 10% still set aside. It is sound because we don't want to see on the news, a bunch of self-managed super funds having to sell their property and people's financial futures being put into harm or detrimental outcomes. So there is some measures around that, just making sure there's some sound practices for self-managed super funds. Just the same, Michael, we're still able, if clients meet all that criteria, they're still very much able to borrow.
Great. Well, thank you, Andrew. That's given us an overview, and clearly the market's changing, and we are going through what some people would call a credit squeeze. That's the name that used to be used many years ago. Having said that, people old enough like Andrew and me who've been in the industry for a long time recognise that there's always ways of doing things, there's always opportunities. You just got to get the right people on your side, in particular now finance brokers, finance strategists who don't just think of this loan but think 2 or 3 steps ahead, which is important. But when you hear all this, some people just think, Andrew, this is just too hard, I'm going to give up. Should investors be worried?
It's a good point. I mean, there are certain markets that, the rates going up. For a lot of clients and a lot of people, the biggest disincentive to investing will be interest rates. I'm not investing at 5%. It's madness when you think about it. You wouldn't invest for maybe 1% differential and potentially cost yourself 10% capital growth, or the markets have even been better than that of recent times. It might be 7% growth. You and I don't know what that will be. Should they be worried? No, I think there's enough regulation going on that if you meet the criteria, and I guess the conversation's been having, you used a great term earlier, Michael, about we're at a mature part of our cycle. So we're starting to get that negative sentiment. We're starting to get people saying, now's not the time and things like that. Well, if any of us knew the right time, Michael, it'd be a lot easier, wouldn't it? Sure. It's time in, not timing. And you're starting to get those conversations happening a lot. Should investors be worried? I don't think so. It's a very normal part of the cycle. I mean, you don't colour your hair for that colour just for a reason. I have no hair for a reason. We've been through it. We've seen it. A little bit of experience means we understand that there's going to be times where it's harder to get finance, and it's those times when some clients just can't invest. The cycle will normalise, it'll come around again, and we'll be able to move forward with your investing cycle, with your investing journey, I guess.
I guess that makes a lot of sense, and I'd much rather have it in this sort of environment, as we said a moment ago, with not such a high interest rate, which means that there won't be mortgage defaults, means that businesses won't have to pay more for the interest so they can employ people and buy equipment.
Yeah.
So what the APRA is doing, and you said it well right at the beginning, most of their regulations and their recommendations have been right, have been well thought out, so it's going to stop the big swings, so we won't have as big a boom, and at the other end we won't have as big a downturn. So it's an interesting environment, but I think on balance a safer environment to invest in, Andrew.
Oh, absolutely, Michael. I mean, like I said, it's we are bound by responsible lending rules and regulations. Arguably, 3 or 4 or 5 years ago, those weren't strict enough. They weren't tight enough. They're there to protect people, and often protect people from themselves. So as long as our clients take the advice, take the recommendations, sometimes, and you've said this quite often, sometimes doing nothing is the right thing in certain times in certain markets. So there are people in that position. There are people that we have to have hard conversations. Years ago I was able to borrow all this money and now you're telling me I can't. Yeah, well, that's what the regulations are there for. It's to protect people from themselves. It's to have a sound lending market. It's to stop boom busts. And like you said, it's very, very, it makes sense to us because we've been through it. And it's just the right thing to do, and to protect people.
Fantastic. So thank you so much for spending the time and giving us some insights, and it'll be interesting when we next chat to see what new changes are going to be there, because I think that's the only constant change, isn't it, Andrew?
Yeah, I think that the bit of advice I can give to everyone would be, if you don't know what it costs you to live, spend a bit of time on your living expenses, do a budget, have an idea of what it actually does. That's going to be the next range of restrictions, living expenses, doing some focus on it, and actually having an idea. Sadly, Michael, a lot of people actually don't know what it costs them to live. So you're going to need to do a bit of work and have an idea of what it costs you month to month to actually live and enjoy life, because we're all here only for a short time.
Fantastic. I think that's really good advice, because to become a good property investor, good businessman, good entrepreneur, you really have to be financially fluent. You've got to understand numbers and figures, and the best place to start is with your own home budgets. Thanks for your time, Andrew.
Absolutely. Thanks, Michael.